Hello and welcome to ED Insight, where we get you a 360-degree view of the big picture in business and economy. I'm Sridhar Ramakrishnan, and here's what we have for you on the show today. Billions of dollars are pouring into Dalal Street, then why is sticky money or FDI eluding India? So just how good an FDI destination is India and what's holding investors back? Pouring into Dalal Street, then why is sticky money or FDI eluding India? So just how good an FDI destination is India and what's holding investors back? And an exclusive interview with Soumitra Chaudhary, member of the Planning Commission, on what India needs to do to improve its FDI inflows. Our top story first. There's no doubt that the bet is on emerging markets like India. In fact, since the beginning of this year, foreign investors have poured in a record $29 billion into Indian equities. But here's the worrying disconnect. Foreign direct investment into long-term assets such as factories is declining. Between July and September, it dropped 37%. So here's the big question. If India is such a hot destination, why isn't more long-term capital coming into the country? Asha Gopalakrishnan gets you the answer.
The bulls are raging. They are coming by the droves. And Dalal Street is on a roll. Much of the money is coming from foreign institutional investors or FIIs who can't get enough of Indian stocks.
Bull markets are built on a wall of worry. You see that all the time. People say, oh God, it's gone up by 30, 40, 50%. Let me take some profits. Yeah, and so you have these corrections along the way. That does not change the basic scenario of a secular bull market that we're in.
India can grow at a trend rate of 8-9% real GDP for the next 5 years. So my operating assumption is India will grow more rapidly than China, 7 to 8%, and if India is growing 8 to 9%, foreigners will want to invest in India. So I view this foreign capital inflows into India as wholly rational and not excessively speculative.
It's rational from the stock market's point of view. But that is not translated into much at the ground level, and FDI flows are languishing. FDI is important because that's the money which really aids ongoing projects. The largest chunk of this money has come from Mauritius, Singapore, US, Japan and the Netherlands. While Mauritius, Singapore and US continue to be the top 3 investors, the US has dropped a notch in the tables in terms of investments. Ditto with UAE and Germany. There is also a change in the sectors that these investors have put their money in. The metal sector is attracting more money and investments in housing and real estate have taken a back seat. Foreign investor interest in IT and petroleum and natural gas has risen this year. But that's not the case for sectors like construction and auto, which were looking far more attractive last year.
Where we are having slowdown in getting the foreign direct investment includes housing, real estate and auto industry also has been hit by foreign direct investment going down in the sense that not getting as much as it was getting earlier.
There are a lot of constraints as far as project financing is concerned in India, and any foreign direct investor would certainly like to see that all these issues are tackled before we go and invest in. Whereas FI money is a direct investment in the running companies where you don't take most of the project risk most of the time. You put money in those the companies which are have gone through the good time.
India is not alone. World over, FDI flows have not recovered completely yet. A UNCTAD report released last month says even though FDI may increase modestly towards the end of the year, flows for the year will be 25% less than the average pre-crisis levels and 40% less than those in the peak year of 2007. UNCTAD's analysis is based on its global quarterly index, which saw a sharp decline in the second quarter of 2010.
FDI is driven by long-term investment planning. Companies plan to expand capacity. So I think you would see this is not unique to India. This is a global investment climate or investment environment response.
Typically, FDI comes in two ways, M&As and greenfield projects. UNCTAD's preliminary data on M&As for the third quarter showed a 27% increase in the value of activity over the previous quarter. The number of deals fell but remained higher than the overall average for 2009. Greenfield investments, the other mode of FDI, saw a decline in value in the third quarter, although the number remained almost the same.
The flow really depends on the ability to invest and so on from outside and so on. I don't think this is a factor that one needs to be worried about on a long-term basis.
We cannot forget that temporarily we are in a situation where we're just coming out of a global crisis. So I think it's a temporary situation. It will change, and more, much more likely, I would believe, is the fact that we will soon see FDI go up as well as we come up with more emerging sectors which are of interest to other countries.
The good news for India is that the decline in FDI flow is more pronounced in developed countries, with some, like United Kingdom and Ireland, seeing negative FDI flows. While developing countries have outperformed developed countries in terms of absolute value of inflows, they have seen a decline in net FDI due to a repatriation of reinvested earnings and a withdrawal or repayment of intra-company loans to affiliates in developed nations.
India's domestic story remains very much intact and strong. So I think if we as a country look at the next 5-10 years, then I think we would have a strong platform to grow further. And as the government has been pushing for a growth rate between 9 and 10%, if we do the infrastructure bit well, and if we ensure that the large projects do come into operations, then I'm sure that the world will find India, or continue to find India, to be one of the most attractive destinations.
It's important for India to be an attractive FDI destination because it represents long-term money that can help build companies operating in capital-intensive sectors like infrastructure. This money can help manage the economy in a more effective manner. Take for instance FDI in retail. Currently, India permits 51% FDI in single-brand retail and 100% in cash and carry stores. FDI in multi-brand retail is not permitted. But if it were, then large retailers such as Walmart could have used their international experience in providing low-priced products to Indian consumers. That, in turn, could help contain rising prices.
Certain increases in direct foreign investment are likely to reduce India's inflation rate by 50 to 70 basis points. We can do this by reducing waste and by driving efficiencies in our stores and in our supply chain.
Here there's a lesson to be learned from the telecom sector, which saw large FDI in the early years. Today, rates are at an all-time low. The subscriber base is rising and the sector has reached the remotest parts of India. Telecom is perhaps the only sector that has delivered up to expectations of investors. In the past few years, long-term investors have also invested big money in power and steel projects, real estate, aviation and roads and highways. Many of these projects are still awaiting clearances.
Moscow shows how difficult it is to get in, and Cairn probably shows how difficult it is to get out. Now if there are difficulties in coming in, if there are difficulties in going out, I would probably prefer maybe Vietnam or China, or there are many other alternatives today.
Here it's important to note that FDI and FII are not mutually exclusive. They have an impact on each other in a rather significant way.
We need to avoid sending wrong signals to the market, wrong signals to the international investors. And that's where I would say the interest rate correction should happen quickly so that they don't build up expectations of high returns in the domestic market.
That means that India has to balance its act sooner than later. If FII flows have to continue at the current momentum, India needs to improve ground realities too. That's because FDI is the real money. It's the money that can help India take a big leap on the international league tables. And here, India can learn many lessons from China, which is neck to neck in the race for FDI with the world's largest economy, the USA.
So just why is India falling behind, and what can it do to keep investors' faith? That and more is coming up after the short break. Stay with us.